Imagine a scenario for a second.
Right.
You're running a business, right? And you just closed out a single quarter.
Just one quarter.
Yeah, exactly. And you bring in a staggering $213.4 billion in sales.
Which is just a massive number.
It's unbelievable, not for the year, just for the quarter.
Yeah.
You actually beat Wall Street's expectations on the top line. By, all traditional metrics, you should be taking a massive victory lap.
You'd think so, yeah.
But instead, the market immediately punishes you. You see this massive valuation contraction right out of the gate.
It sounds completely counterintuitive.
It really does. But that is exactly what just happened with Amazon, one of the biggest tech and retail giants on the planet, following their recent fourth quarter results.
Welcome to today's deep dive. We have a fascinating stack of financial analysis notes, market excerpts, and forward-looking outlooks to get through today.
It really is the ultimate case study in how the modern stock market operates.
Yeah.
Particularly when we're dealing with companies at this kind of, unprecedented scale.
Right. Because on the surface, those top-line numbers look untouchable. But when you look at the forward guidance and the underlying cost structures, there is a much more complex story happening. It's regarding the literal price tag of the future.
And our goal today is to help you connect the dots between these quarterly earnings, the seemingly harsh reaction from Wall Street, and what this tells us about the rapidly escalating artificial intelligence race.
We are going to decode this financial mystery for you.
Yeah, the mission here is to translate the market signals from our sources and figure out why a business of this magnitude is making a historic, wallet-draining gamble on AI right now.
Okay, let's unpack this by starting with the actual data drop from the fourth quarter.
Because the numbers here are incredibly specific.
They are, and they set the stage for everything else. So they posted sales of $213.4 billion.
And the average analyst estimate had modeled for sales of $211.3 billion.
Right, so a clear beat on the revenue side.
A definite beat. But then we look at the earnings. They posted non-GAAP or adjusted earnings of $1.95 per share.
While Wall Street had modeled for $1.97 per share.
Exactly. That is a 2-cent miss on the earnings per share.
2 cents.
2 cents. And the market reacted by wiping billions off the market cap.
Which seems absurd in a vacuum, right?
Absolutely.
A 2-cent miss on nearly $2 of adjusted earnings per share when you are pulling in over $200 billion in a quarter.
It sounds like an overreaction.
It does. But we have to look past just that 2-cent miss.
Yeah.
The analysts we're following point out that investors didn't just casually react to a rounding error. They bristled at higher than anticipated costs across the entire board.
So they were looking at the outflow.
Exactly. The market was looking at the sheer velocity of the money flowing out the door. It was the guidance for massive capital expenditures in the coming year that really spooked the short-term investors. It's a clear signal that the cost of doing business is accelerating faster than the revenue.
Right, so it's not about the 2 cents. It's about the trajectory. Let's put this into a real-world business perspective for you. Think about a legacy automaker right now.
Okay, good analogy.
They might have a phenomenal quarter selling highly profitable combustion engine trucks. The revenue is through the roof.
Everyone is getting a bonus.
Exactly. But if they simultaneously announce they're completely halting those profitable production lines to spend tens of billions building new EV battery gigafactories.
Their short-term profit is going to tank.
It has to. The top line is great, but the retooling cost eats the net income. They are taking a massive temporary hit to ensure they actually survive the next decade.
That is basically what happened here.
The sales were phenomenal, but the costs involved in retooling the machine for the next era ate into the actual earnings. Like getting a raise at work, but your living expenses skyrocketed even faster, so you actually have less cash in your pocket.
That is a much more accurate way to visualize the scale of what is happening.
Right.
Wall Street, by its very nature, wants to see profit margins expanding today.
Not 5 years from now.
Right. When they see a company generating over $213 billion in a quarter, but missing the mark on the bottom line, it signals that the machinery is running incredibly hot. And that brings us to the forward guidance.
Which is where the real sticker shock happened. We have to talk about the absolute elephant in the room. You mentioned capital expenditures, or Capex.
Yes.
Amazon has announced guidance to spend roughly $200 billion on Capex this year alone.
$200 billion.
$200 billion. Just for context, they are essentially spending the entire GDP of New Zealand this year just on their infrastructure and growth bets.
What's fascinating here is the sheer tension this creates between the company's boardroom and the trading floor.
Because the trading floor hates that number.
They despise it.
Yeah.
Where's all that money actually going?
Yeah.
If you look at their forward guidance, they were spending this $200 billion primarily to continue building out their AI infrastructure.
We are talking about acquiring specialized silicon.
Securing the energy grid contracts to power massive new data centers.
And building the physical architecture required to train and run next-generation models.
Exactly. This massive capital expenditure outlay is going to put a substantial damper on near-term earnings. Both this year and the analysis suggests it is very reasonable to expect another huge round of Capex next year as well.
Which is what terrifies a certain class of investor.
They see a depressed earnings outlook for a 24-month horizon because a historic amount of cash is being shoveled into infrastructure.
But the stakes are astronomically high. Our sources point out that this isn't spending for the sake of spending.
Not at all.
This is an intense, existential competition among a very small handful of tech giants. They are heavily spending to avoid getting left behind in the AI race entirely.
It's a game of musical chairs with trillion-dollar market caps.
They are looking at the landscape and deciding that if they don't spend the equivalent of a sovereign nation's economy right now, they might lose their dominant position over the long haul.
I take it a step further. It's not just about maintaining a dominant position. It's about not becoming obsolete. Wall Street operates on a strict quarter-to-quarter mentality, but building foundational AI infrastructure is a multi-year endeavor.
It requires massive upfront investment.
The hardware pipelines alone take years to establish. The analysts note that these big investment pushes will absolutely depress earnings this year. There is no sugarcoating that reality. But they're betting on categories that have the potential to deliver exponential payoffs over the next decade.
Here's where it gets really interesting, though. Because despite this massive near-term hit to their earnings, the financial analysts we are reviewing actually argue there are very strong reasons to continue liking Amazon as a long-term AI stock.
It's not all doom and gloom.
Right. They point to two distinct massive engines that power this company.
The cloud infrastructure business and the e-commerce business.
Let's look at the first engine, Amazon Web Services, or AWS. They continue to outright lead the cloud infrastructure market. The numbers from last quarter show AWS sales growth at roughly 24%.
Which actually topped Wall Street's expectations.
It did. But the metric that jumps off the page for AWS is the operating margin, which sat at a fantastic 35% last quarter.
A 35% operating margin at that scale is a profit-generating machine.
It's incredible.
But to understand why the analysts remain bullish, we have to look at how AWS functions in the broader AI ecosystem. AWS is positioned to enjoy massive, sustained sales tailwinds.
Why is that?
Because as more AI applications are developed by third parties, as they're launched, and as they scale up to millions of users, they're going to do so across the AWS platform. The cloud is the bedrock that all this new AI software requires to function.
So as the entire tech sector rushes to build AI tools, they are essentially forced to rent the computing power from AWS to do it.
Exactly, from scrappy startups to massive enterprise software companies.
It's the classic selling pickaxes during a gold rush scenario. But wait, if AWS is already a profit machine with a 35% margin, why do they need to sacrifice this year's earnings to build out even more infrastructure? Couldn't they just coast on that incredible margin?
I'd push back on the idea of coasting in this sector. The compute demands of artificial intelligence, particularly large language models and generative AI, are orders of magnitude higher than traditional cloud hosting.
Because hosting a traditional website is relatively cheap.
Very cheap. But training and running inference on a multi-trillion parameter AI model requires specialized GPU clusters that cost billions to deploy. Not to mention an immense amount of electricity to run.
So if AWS doesn't spend that $200 billion to build those specific high-density AI data centers,
those third-party developers will simply take their gold rush money to a competitor's cloud. The 35% margin only exists as long as they have the best infrastructure to rent out.
that makes the Capex number a lot more understandable. It's defensive as much as it is offensive. And then you have the second engine, which is the e-commerce side of things.
The physical side of the business.
Right, the side you and I interact with every single day. The source material notes that Amazon is still in the very early innings when it comes to leveraging the benefits of AI and robotics in their retail operations.
This is where the underlying math of their business model becomes really compelling. When you think about their retail operations, you have to think about complex physical logistics.
Automated warehouses, predictive inventory management, dynamically routed delivery networks.
Precisely. Massive investments in physical AI and advanced robotics are designed to make all of those physical processes slightly more efficient. Over the long term, the analysts project these investments will help the e-commerce unit significantly expand its margins.
Because their sales base is just so colossal. When you are moving hundreds of billions of dollars worth of physical goods, you don't need to increase your profit margin by 20% to see a massive financial impact.
Not at all.
Because of that huge sales base, even moderate margin improvements from AI and automation translate to a huge difference to the bottom line. If an advanced predictive routing algorithm or a new generation of fulfillment center robots saves a fraction of a cent on every single package shipped globally,
That scales up to billions of dollars in realized profit almost immediately. It is a pure game of scale. A 1% improvement in efficiency applied to a massive global logistics network completely transforms the financial profile of the company.
so you have AWS generating high-margin profits from the software side of the AI boom.
And you have the retail business utilizing the physical side of AI to squeeze unprecedented efficiencies out of global logistics.
This dual-engine setup is why the long-term outlook remains strong in analysis, despite the heavy drag of current capital expenditures. But let's ground this in where the stock actually sits today and look at the recent history, because it hasn't just been a straight line up.
Far from it.
When you look at their $2.3 trillion market cap today, it's hard to imagine them struggling. But the 52-week volatility tells a story of a market that is highly indecisive about this exact gamble.
Let's hear the vital signs.
Over the last year, the price has swung from a low of $161.38 all the way up to $258.60.
A massive swing.
Before settling around $217.02 today, and despite a very healthy gross margin sitting at 50.29%, the stock's performance over a longer timeline is actually quite surprising.
If we connect this to the bigger picture, the performance over the last half-decade tells a story of significant, sustained friction. The analysts point out that over the last 5 years, the S&P 500, the broader market index, has risen roughly 77%.
Okay.
But over that same 5-year stretch, Amazon stock is up just 32%.
That is wild to think about. A foundational tech giant, one of the biggest companies in the world, basically got lapped by the broader market over a 5-year period. The S&P more than doubled their growth. What exactly caused that massive drag?
We have to look at the macroeconomic environment they've been operating in. The analysis attributes this to a combination of heavy pressures that disproportionately affected physical logistics businesses.
So, pandemic-related issues.
Exactly. Massive pandemic disruptions that fundamentally whipsawed global supply chains, forcing them to overbuild capacity and then scale it back. You had soaring inflation, which drove up the cost of labor, fuel, and materials.
And an incredibly aggressive interest rate environment.
All of these factors acted as heavyweights. They severely dampened the stock's overall performance compared to a broader market index that includes software companies without massive physical footprints.
So they have been fighting these brutal macroeconomic headwinds for years, trying to stabilize the physical business. And now, just as things start to normalize, they have to pivot into this massive AI spending cycle.
It's relentless.
Which brings us to the current broader market context, because the environment out there right now is incredibly anxious. Our sources highlight a really fascinating macroeconomic debate playing out between two major outlooks.
It perfectly captures the uncertainty investors are feeling.
On one side, you have UBS coming out with a highly bullish projection, predicting the S&P 500 could climb to 7,500 by the year 2026.
That is a staggering projection. A 7,500 target implies that UBS believes the massive investments being made in artificial intelligence across the tech sector are going to translate into real systemic productivity gains across the entire economy.
It's a thesis that AI will make every sector more efficient, driving a massive bull run.
But on the exact opposite side of the spectrum, the notes highlight a stark warning from Bill Gates.
Right. He is actively sounding the alarm that many investments being made right now could turn out to be, in his words, dead ends.
And this is the classic paradox of a technological revolution. You have extreme institutional optimism clashing directly with high-profile warnings from industry veterans about capital misallocation.
When Gates talks about dead ends, he is likely referring to the massive flood of capital going into companies that are simply building thin wrappers around existing AI models.
Or infrastructure projects that will become obsolete before they are ever finished.
Yeah.
The fear is that the market is blindly throwing trillions of dollars at anything with AI in the name.
And a significant portion of that capital is going to evaporate when those business models prove unsustainable. It really makes you wonder how an everyday investor is supposed to navigate that kind of polarized environment.
It's a challenge.
Do you buy into the UBS thesis and chase that 7,500 S&P target, hoping the productivity boom lifts all boats? Or do you get defensive because you're terrified of holding the bag on these dead-end investments Gates is warning about?
According to the financial analysts we are reviewing today, the conclusion on Amazon specifically is actually quite decisive.
It is. The core argument from the analysts is that the market right now is heavily discounting the company's long-term AI opportunities simply because of those short-term Capex fears.
Yes, the intense competition and the required $200 billion in spending comes with substantial risks. But they aren't a startup trying to find a business model.
They already have incredibly strong positioning.
Exactly. The company's existing foundations, their massive, highly profitable laid-in cloud infrastructure, their unparalleled physical e-commerce footprint, and their massive logistics network give them the actual structural setup needed to facilitate strong returns on these AI investments.
They aren't starting from scratch. They are retrofitting a $2.3 trillion empire. They already have the customer base, they already have the data, and they already have the infrastructure.
Which, according to the sources, positions the business to be a massive winner over the next decade and beyond.
Regardless of how much the earnings get depressed in the next 12 to 24 months. So what does this all mean for you as you watch these financial headlines roll in?
It's the big question.
Ultimately, this deep dive is a masterclass in the immense tension between Wall Street's relentless desire for immediate, quarter-by-quarter profit expansion and a massive tech giant's absolute need to spend historic fortunes to secure its own survival in a new era.
Well said.
When you see a company punished by the market for spending money, you always have to look at what they are actually buying. In this case, they aren't just buying servers, they are buying the foundational infrastructure of the future.
And this raises an important question to leave you with, looking slightly beyond just this one company.
Let's hear it.
If a foundational tech giant, a company that already dominates global e-commerce and cloud computing, has to essentially drain its wallet to the tune of $200 billion just to keep pace in AI infrastructure, what happens to the thousands of mid-cap tech companies? What happens to the startups?
The barrier to entry just seems impossibly high.
We might be looking at the dawn of an era where true foundational innovation is no longer born in a scrappy garage, but can only exist inside the incredibly well-funded vaults of 5 megacorporations who can actually afford the price of admission. Will the future of AI belong exclusively to them?
That is a fascinating and honestly slightly terrifying thing to ponder. It certainly changes how you look at the entire tech landscape moving forward. Thank you so much for joining us on this deep dive. We hope this helped clear up the noise, decode the numbers, and gave you a new lens to look through the next time you see a massive earnings report cross your feed. Keep questioning the mechanics behind the headlines, and we will catch you next time.